Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. Whilst I just let you have a look at the disclaimer, this week we'll check out a couple of themes actually, one narrative actually and one theme which we find quite interesting at the moment. One is about the dollar smile, and I'll go through that briefly shortly with a nice chart just to explain that idea. And then we'll also look at the narrative around some of these systematic funds, quants who have been loading up in equity markets as in contrast actually to some of the active money managers who are still underweight. We'll look at the repercussions behind that for the VIX, the volatility index, of course, and the what happens to some of the US major indices, stock indices, that is, going forward. We'll then just look at some of the technicals then around the S&P 500, the Dow, the Nasdaq 100, and also the FTSEs at an interesting juncture. That's the UK FTSE 100. We'll then just look at the main events from last week. So that's the US CPI data and the Bank of England decision, the rate decision, which then leads us into this week's main data, main risk events. Not really that many central banks at all, of course, meetings going on this week, but a lot of data to digest. The UK has wage, jobs data and wage earnings, which are important feeder for the Bank of England at their next meeting for sure. And then on the US side, we have quite important earnings from some of the big retail stocks, as well as then leading us into retail sales data, which will be interesting for a pointer for the US consumer and the strength of the US consumer, of course. We'll then look as well, hopefully we have time, at some of the Australian data coming out and also Canadian CPI. All the while, of course, looking at all those major currencies affected by that data. So Aussie against the dollar, of course, CAD against the dollar. We'll also look at euro dollar in general. Not a lot of data out in Europe, but some ECB speakers may be of interest. So we'll look at euro dollar, of course, technically, and then also the DXY, of course, to do with all that US data. Okay, first up is, just a general outlier on where markets are at the moment. European equities really mostly higher, quite a slow start to regional news flow. Asia Pacific stocks, they traded mixed following that kind of subdued handover from Wall Street on Friday. Risk sentiment was hampered slightly by a disappointing University of Michigan survey, and also, of course, these US debt ceiling concerns. Traders in the region, in Asia at least, are braced for Chinese activity data overnight tonight. And then FX wise, I always have this chart actually. So on the left hand side is last week's year to date performance for the major FX currencies against the dollar, and then on the right hand side is a clipping of performance very recently. So FX wise, just to start the week, well, year to date at least, still got these European leaders, so sterling, Swissy and the euro leading the way, although you can see that the dollar has certainly pulled back, and we'll look at the DXY chart, as I say, shortly. So you can just see some of this strength, certainly sterling coming off its highs, euro dollar coming off its highs and losing over 1% or so from last week. On the flip side, you've got the Aussie and the Kiwi, the Antipodeans, they're losing ground last week at least. a couple of percent, you can see really for the Kiwi, 1.6% or so on the Aussie as commodities really fell, especially copper, interesting point, falling through its 200-day moving average, actually driving those two currencies lower for sure. And then the yen also losing against the dollar, this is, and we'll just check that out later on. Okay, I just wanted to show you first, actually, the one of the narratives which is of interest to us, at least, is around the dollar smile. Actually, is what I mentioned before. Sorry, let me just find the chart. So here we are, the dollar smile. I have talked about this recently, actually, the last few, I'm sure, at least a few weeks ago. And this is really around the fact that the US currency does best when the global economy, its economy is either very strong or very weak. And then it tends to perform less well, that's the dollar, when growth is unexceptional. So until now, really, or you can see on the chart then, dollar appreciates at either end of this scale, and it's actually one Norwegian investment bank, or Scandinavian investment bank, I should say, that has sort of given this idea of a dollar smile. So strong appreciation either end of when global growth is either very strong or very weak. So in the current environment, just bear with me one second. Apologies, just a couple of technical issues. Right, so yes, in the current environment for the dollar smile, well, until now, the slowdown has not been that dramatic and really consistent, and is quite consistent, therefore, with a weakening dollar. But potentially, if we are getting to a point where prospects are now getting worse, potentially, on the economic data front, then that could then therefore make the dollar smile, if you like, again. And a more protracted slump that spills over into the rest of the world, for sure, that could push markets to probably the left-hand side of this chart, really, if you like, and make the dollar smile again, if you like. That's kind of probably not the base case for most, but just something to bear in mind, just a sort of simple way of thinking about sometimes dollar strength. As I say, not the base case, but it's very much data dependent, of course, which means a pickup. There could be a pickup in volatility, as of course all the focus is on economic data releases going forward. Just something to think about then. We quite like this idea. It's quite simple and quite easy to get our heads around, and going forward, it could be of interest. The other interesting narrative we think is worth looking at the moment is around volatility and around these systematic quant funds, if you like. Don't want to get too technical for sure. Let me just pull up the VIX first of all, which we've shown you before. But these funds, they use algorithms, algos, really, to automatically detect trends and ride momentum across numerous different markets. And that's against, of course, active money managers who are probably more emotional slightly, and they look at obviously fundamentals, earnings, inflation, that type of thing. I think it's interesting that obviously last year we saw wild swings in markets that encouraged systematic quants really to reduce their exposure, or even, of course, bet on further declines, and that kind of has exacerbated the downturn. And of course, the S&P ended up closing down 19% last year. However, then volatility has fallen dramatically since the fourth quarter, really, as fears about US interest rate rises, certainly, and the health of the global economy kind of eased. We're kind of picking up that theme possibly now, but generally eased over the last few months. And then if you think about the VIX, that basically is, we've talked about it, Wall Street's fear gauge, if you like, and that reflects expected S&P 500, so stock market swings essentially over the coming 30 days. And that's actually closed below its long-term average 57 times so far this year. And that compares with just 23 times in the whole of last year. And actually in April, this backward-looking index basically of realized volatility hit its lowest level since November 2021. If we just pull it back, you can see here going back to sort of November last year. And even after the recent pickup, actually, it remains less than half last year's average. So you can see sort of last year bouts of strong, high volatility, but the average was much higher than what we're seeing over the last or over recent times. The falls basically in this volatility measure in the VIX have automatically actually prompt a lot of these quant funds to then ramp up their stock investments. And I think one investment bank actually has estimated that these funds have added 72 billion in US stocks in the past 3 months. Kind of big figure, of course, but put that into context, that was a greater flow than in 80% of 3-month periods over the past decade. So, as I say, that contrasts massively or very sharply with stock market exposure among active managers, which is close to a 1-year low. So it's kind of interesting for us just to think about this as another narrative, another theme. These funds, the quant funds, they don't tend to lead the market, but they kind of amplify moves that are already happening. And this is the case then if we look at these discretionary managers, these active fund managers, if they continue to be underweight, then potentially have to increase their exposure. There is kind of a limit to how much the quants can do and whether the active managers then take on this bullish move or this strong move really to the start of the year, at least, or positive start to the year that we've already seen. Otherwise, if we just look at sort of technicals, let's just first look at the S&P 500, of course, or generally US equities. We've still got, of course, the US regional bank concerns. They still linger for us, even though they don't make the headlines. I think it's interesting that we have to remember banking system stress is the equivalent to around probably a 50 basis point hike now. That means the tightening of credit from stress in the banking sector is of course, it would have been likely that the Fed would have had to tighten further, but because of this contraction in credit, then that's equivalent to, as I say, basically a 50 basis point hike. And for policymakers, then it's kind of very tough to manage these tightening credit conditions we're seeing, of course, then during a hiking cycle, because credit contracts very slowly at first, but then accelerates later on. And I think that's something to bear in mind going forward through towards the end of this year. Otherwise, closer to home again, S&P 500, we've got the weekly chart here for technicals. You can see actually a very, very narrow range for last week. It was actually the smallest 5-day range since mid-November of last year. And the index was down. Actually, you can see very small candle there, down 0.29% on the week, and actually an inside week as well. So not surprising, very small range, and very much the high and the low inside the previous week's high to low range there. So sort of denoting some indecision, slightly lackluster really price action, and waiting for the next catalyst really. The Nasdaq, that finished up actually 0.61%, and the Dow was off 1.24% on the week. If we just look at the technicals, then again we can see for us key 4,200 level or so. That's the 100-week moving average, that grey line, and then the top from well, this year's top actually at 4,195. So 4,200, big resistance zone for us, and then potentially if we roll over and we can't break higher above that level, then we have this trend line resistance it was, but now support, which probably comes in around just above 4,000 or so. If we just look on the daily, you can see we extended that line, it would be, yeah, just above 4,000. So probably 440, sorry, 4040, so 4,040 or so, just below there. Tallies with the blue line, which is a 50-day moving average, 4057, and then below there you've got the 100-day moving average at 4,020. So sort of big support around these levels, and then the recent lows from late April and the start of May around 4048. So sort of tracking sideways, as you can see, big resistance above around 4,200 and quite strong support just above 4,000. Looks like we're tracking sideways, waiting for probably the debt ceiling drama to resolve itself. And then we move on back to possibly bank concerns or just a slowdown in the data as we go forward. Just on the NASDAQ 100, just go to the weekly. You can see again, 100-week moving average at 13,440. We have pointed that out as an upside target when we were sort of chopping around here, waiting for a break higher. This was to us bullish consolidation, really, because we are holding above that key January level at 12,880. We did do that. You can see a couple of weeks ago, pushing above the recent high. And then last week, although we closed off the highs, we were still higher on the week, as I say, 0.61% up. So marginally higher, but printing a green candle. So yeah, upside level 13,440, another 100 points or so. First upside target. We did get to where 14,427. You can see if we do push above there, then we think we're probably aiming for the mid-August high, 13,700 or so. 12,880, certainly a big level of support for us in the NASDAQ 100. Just on the Dow, again, usual story, really. We've got this big, we talk about it a lot, have done over numerous weeks, the big sort of resistance level around 34,281. We tapped there. Start of May, you can see 34,257, got close really, but then rolled over and down below the 100-week moving average again. As it is messy, you can see on the daily, really messy sort of sideways trade, really. Should probably take out that channel. And we're sort of supported at the moment by the 50-day and the 100-day moving average. 33,152, the 50-day. You can see tap there a couple of times. 100-day probably less. Yeah, still significant. 33,334. And then below that, you've got the black line, which is a 200-day moving average, 32,754. So tracking sideways, waiting really for some sort of catalyst to break down or break higher. I mentioned the FTSE just for us, quite interesting level really on the daily. You can see sort of confluence of indicators of support really after falling back below 7,900. We've got the 50-day and the 100-day around sort of 7,727, 7,743. And we're just moving above those now as support, acting as support, as well as a sort of long-term fib level. Well, it's not long-term, actually, it's just a sort of minor fib level, I should say, of the October rally. That's at 7,730. So decent levels of support, zone of support, if you like, and we're just moving higher then, potentially, if we can push above probably the, where are we? Yeah, probably, well, probably the, just checking, sorry, 7,800 probably, then we need to get to push above there. We're close to that to then have a look at, again, 7,900 on the FTSE 100. Okay, let's quickly review now the last week's main events. We've got US CPI data, of course, was a big data point in the US. Inflation figures. You've got a graphic here with the main inflation numbers. That's been updated, obviously, from the preview we showed you last week. Slightly weaker than expected, caused US Treasury yields at least to decline on the day, improved the rather sort of fragile risk sentiment again on the day. Headline inflation, 4.9%. First time we've seen a sub 5% number since April 2021. Core printed at 5.5%. That was in line with forecasts. monthly basis, they both actually, headline and core, putting at 0.4%, so still strong. We keep on talking about the sort of 0.17 percentage number. A lot of economists cite as being needed to bring monthly inflation back down in time to the Fed's, below the Fed's 2% target. So we're some way off that. The headline actually rose from the prior 0.1%, while the core monthly reading matched the March print. But just looking sort of under the hood, if you like, details in the reports were to the soft side. So, for example, food prices were unchanged actually for a second month, which is certainly, they're not going up, so that's a good thing. And that kind of suggests the secondary impacts of commodity inflation potentially have passed. And then we had important services ex-shelter component, so it's kind of called the super core, which is Fed Chair Powell's preferred measure of CPI. And that showed signs again of easing underlying price pressures. And that's certainly good news for the Fed. And the soft print, yeah, as I say, sort of caused US Treasury yields to decline, most notably at the front end. So for now, it kind of seems that the Fed pause has been consolidated. There's just less than 3 times a quarter percentage point of rate cuts. It's kind of oscillating between 65 basis points and 75 basis points of cuts priced in for the second half of the year from the Fed in money markets. And just on this chart, you can kind of see that market pricing actually was from Friday, not much change from Friday though. So you can see pricing of cuts now, as opposed to, well, where we are, of course, 5% to 5.25%. And then the latest dot plots sort of was much higher than where markets are pricing in now. As I say, yeah, so yields sort of came off. The tech-heavy Nasdaq, actually, that is particularly sensitive to US yields. That actually added 1% on the day last Wednesday, or after the US CPI data. Of course, there is a lot of data on watch ahead of the June FOMC meeting. That includes another CPI print and, of course, another non-farm payroll report. But certainly, if we think about that non-farm payroll report from the start of the month, then still sort of showed tight labor markets, which is obviously a worry to numerous members on the FOMC who continue to worry about the wage growth figures creating some kind of price pressures. As for the 70 basis points of rate cuts or so, of course, for this year, potentially, of course, or certainly that needs to be, justified from this data going forward. So that's growth data, that's labor market metrics especially. And you can kind of visualize that the labor market has been strong, presumed to be strong. So if there is any turnaround, especially in the unemployment rate that we've been highlighting, obviously on its lows, multi-decade lows, actually 3.4%. But if that starts to tick up now, especially with some of these weekly, more frequent jobs data that we've seen, so the initial jobless claims obviously ticking up, that means potentially some of these big job announcements and generally hiring in the US is abating, and we're seeing actually job losses going forward. That's just potentially, we haven't seen them yet. And then, as I mentioned, sort of further out by 2024, certainly, then this pullback that we talked about in bank lending and certainly the tightening of standards, that may come through in that sort of data that we've already seen actually last week in the credit data, and that senior loan officer survey, the Fed's loan officer survey. If you remember, we highlighted that came out on Monday last week. And it's really, we're still having a full effect on the economy. The survey actually reported a tightening in lending standards and an increase in spreads over banks' costs of funds. And that was actually similar in breadth to those seen during the pandemic, 2008, and actually the 2001 tech wreck. So Really something to pay attention on. Markets are, I know we are paying attention to some of these surveys, lending surveys, as the sort of banking crisis filters through into the wider economy. Okay, also last week then, just moving on, we had the Bank of England meeting, of course. Here you've got a review of all the key numbers. We did actually show you this last week, but we've updated it slightly. Just important to remember some of these key data points that the Bank of England look at. Of course, they hiked by 25 basis points, taking base rate to 4.5%. That was via a 7-2 split. So once again, MPC members Tenreo and Dhingra voted for an unchanged rate. But quite interesting, there were no dissenters for a rate cut for now, at least. The MPC stayed away from signaling a pause for the June meeting, as recent stronger growth data, higher than expected inflation, you can see here, and then obviously solid labour market numbers as well, kind of fulfilled the Bank of England's condition of more persistent inflationary pressures. They've talked about this a lot. It's well known out there now. Persistent inflationary pressures is what they want to see, or what they are seeing. And even more actually with some of their forecasts, which we got and saw. So near-term inflation forecasts were adjusted higher for this year to 5% from 4%. Previously, and inflation, but then interestingly, inflation in 2025 is seen materially below the MPC's 2% target at just 1%. So something to bear in mind further out for sure. Growth projections, they were always also revised higher with the recession forecast removed, while the unemployment rate will be lower for longer. As for guidance, we thought it would be very important to focus on. That was pretty much unchanged, actually. So guidance on future policy, on monetary policy, hasn't changed between March and this meeting last week. The Bank of England really still makes further rate hikes conditional on those persistent inflationary pressures, but with the data still being fairly strong, then potentially we get another hike. You can see terminal rate 4.75%, I think just a touch higher than that actually. So one more hike at least to come from them. That's what money markets think, but dependent, of course, on that persistence word. Gives us a good lead actually into this week's main data. As I said, in the UK at least, is jobs data, wage growth especially. This series has been volatile recently, so that increases or movements will affect sterling for sure. The unemployment rate is seen holding steady at 3.8%. But headlines earning growth, that's the key figure for the MPC really. Well, it's forecast to slow to 5.8% from 5.9%, as weaker bonuses helped drive overall earnings growth down, whilst the ex-bonus metric, that is probably the key one, the one that always gets the headlines, is seen possibly ticking up from 6.6%, 6.2, 6.7, 6.8%. The prior report, that was characterized by a pickup in pay growth, as I said, to 6.6 from 6.5%. And that really had a big influence on the MPC hiking alongside the hot March CPI data. We note actually that there is then the next UK CPI data, which we'll review for sure. That's next week, actually, next Wednesday, May 24th. Market, as I say, currently pricing in terminal rate around 4.75%. I think there's around a 75% chance just above that actually of a 25 basis point hike at the June meeting. And certainly then if we get persistent wage growth data still being strong, still being up this well above 6%, then that could potentially push market pricing to another hike after June. And that certainly will support sterling going forward. Of course, flip side, potential downside risks are relatively high with this quite aggressive pricing for another hike plus a bit more maybe. So that may have a bearing on sterling going forward. Just let's look at cable. So that's sterling against the dollar. We had this, of course, consolidating around the highs, kind of looked as though it could be bullish consolidation. We printed at last week 126.79 the high, but then just rolled over 2 days, 2 strong days lower actually. Big 2-day drop of close to 1.5% actually. That was after that 1-year high at 126.79. That actually corresponds that high. If we're just going back, just to point it out, you can see the 100-week moving average of 126.93. So it got close to that, as well as then these highs from May back last year. So 1-year highs, you can see 126.66, 126.59. So that sort of zone now, that area becomes a zone of resistance, if you like, especially with the print and then not being able to really sustain that. But key for us, we've highlighted it before, is this previous January high at 124.47. So if we can stay there, we highlighted it last week and previous weeks, where we sort of tacked up, trading up and above and below it, sorry, but holding really on, you can see just tacking sideways and then pushing up there. And we sort of, where did we close last week? 126.44, so a touch below it, actually, really interesting. But then this week, decent start, and we're above 125 now. So as long as we hold that, then for us, still bullish, long-term trend, essentially for higher prices. But that is key. Otherwise, then we push below that, we get towards the 50-day moving average, probably 123.65, and ahead of that, probably this sort of noise, quite a lot of support. Actually around that 50-day moving average. So these lows from April around sort of 123.60 area. So that's cable. Moving on to the US. Let me just pull up a chart for you. Bear with me 1 second. So next up, US. Well, before we get to US retail sales, actually, coming week, we said about earnings from the likes actually of Walmart. They're on Thursday, Target Wednesday, Home Depot tomorrow. They'll give us an insight into the spending power of the US consumer. We've now had around, I think, 92% of the S&P 500 companies having reported their first quarter earnings for this year. So those 3 companies will be really of interest, to see how strong the US consumer is. We then, of course, get retail sales tomorrow. The most recent numbers, and you can just kind of see the downturn on this chart here. The most recent numbers for March showed really quite an alarming deceleration. Just to note, the freakish sort of declines during the 2020 lockdowns and then the rises a year later caused by base effects. They've been taken out of this chart by Bloomberg, by John Authors. But it just shows you the declines that we've seen recently. For this report anyway, on Tuesday, headline retail sales actually seen bouncing, so rising 0.7% month on month in April. That offsets some of the 1% month on month decline in March. Core retail sales seen up 0.5%. Previous was actually down 0.8%, while the control group is expected to contract by 0.3% month on month. That actually matches the March decline. Just around retail sales, the Bank of America, they put out their sort of consumer checkpoint report, which kind of presented further signs that consumer spending was softening. Total card spending per household dropped actually first into negative territory. First time it's had a negative reading since February 2021. And then the bank actually, they said that in aggregate, so in total, actually, the labor market landscape remains solid, but its data suggests more deterioration or some deterioration at the higher end of the income distribution. Quite interesting, actually. So unemployment is actually rising fastest among higher income households, while their pay growth is weakest. And the bank actually went on to say the higher income spending growth on discretionary items has also fallen below lower and middle income households. Against that, household or consumer savings buffers, they remain quite elevated, and the median balance actually continues to be over 40% higher than the average in 2019. That's across all income brackets. So just an aside there, or background to potentially where US retail sales are headed. We also get lots of Fed speakers actually. Just while I pull up the DXY chart, you can see there. Yeah, a lot of Fed speakers this week. Cook, Kashkari, Goolsbee, Bostic, rounded up actually with Fed Chair Powell speaking on Friday. As I said, we've got around 70 basis points of cuts priced in by the end of the year now. So potentially we'll see some pushback by these Fed speakers to this, and that could offer some support to the dollar. Obviously, we have the debt ceiling drama, and negotiations between President Biden and congressional leaders should resume tomorrow after the postponement of the Friday meeting. You kind of think though that, but unless there is sort of some very encouraging progress, which doesn't look likely at the moment, then investors' fears may keep growing. That really then points to potential more upside as well for the dollar, as really investors seek safe haven flows as risk sentiment sort of stays subdued. Tallies with kind of that all those stock charts we looked at and just tracking sideways, waiting for a catalyst. This is a DXY chart. There's lots of dotted lines actually, which makes it slightly confusing. Apologies for that. If we just get rid of some long-term levels that I have had in there from kind of the post-pandemic highs, 2018 lows actually, but just taking those away, you can see long-term downtrend for sure. Potentially we've broken that trend line resistance. You can see, let's just pull up the weekly. Yeah, so just expanding that out, you can see that long-term trend line. Obviously, consecutive weeks of declines in the dollar, and then this big move obviously last week breaking above that long-term trend line resistance. If we just pull it out, you can see it there. So we're now sort of tracking, well, got above the 50-day moving average, not quite as far as the 100-day moving average, 102.92. Got to the 50-day, but then we're sort of tracking on it now, 102.48, the 50-day moving average there. If we do roll over, then certainly trend line support comes in around sort of just below 102 there, but potentially roll down. Otherwise, we have to push above sort of probably 102.92 area to get to see more upside in the dollar. Just briefly look at euro dollar and the chart as well. Most of the interesting stories for sure at the moment in FX come from the US. So much will really depend on the dollar leg for this pair, at least euro dollar and most other majors at the moment. Obviously, debt limit impasse, if you like, in focus. And then obviously the size of Fed easing potentially if we move away from the debt limit issues. As for the Eurozone, yeah, pretty empty calendar. We had some German inflation data actually easing slightly, so that's helped stocks in the Eurozone. And then we get the ZEW, so that's a German business sentiment survey. That's out tomorrow. And we get preliminary, well, second Q1 GDP figures out tomorrow as well. We do get lots of ECB speakers on the wires. Interesting, really, to see what they've said, although they have had quite a limited impact on the euro. Quite interesting that, really. Markets pricing for, well, for another June hike. That's priced in now, so that's probably why we're ignoring ECB speakers. And then potentially the July meeting has kind of remained broadly unchanged since ECB meeting. I think there's around 15 basis points of extra tightening expected at that meeting after the 25 basis point nailed on hike in June. So 15 basis points is around a 60% chance of another hike, if you like. We do hear from an archhawk, Nagel, German ECB member today, and then we get President Lagarde actually, plus other members later on in the week. As for euro dollar, then technically, kind of downside risk persist really. If you think about what we've just talked about, the dollar for sure. You can just see us rolling over. So we broke through that near-term trend line support there, which we had. It was only near-term, but we held above sort of 109.42, which is this dotted line, which if I just pull out is the halfway point of the 2021-2022 decline. I've left that in there as a long-term level, but we pushed down below that now, and we are now tracking on the 50-day moving average, which is pretty much like the DXY, of course. Remember that the euro has around 57% weighting in the DXY. So yes, holding support at sort of 108.73 here at the 50-day moving average. If we do get that dollar strength, then potentially we push lower towards that 100-day, really for us, probably quite a good marker around that April low you can see there. Just below 108. So round number, nice round number to look out for if we do move below probably last week's low and conclusively, decisively below the 50-day moving average. Last week's low, a 108.47. So that's initial support. Okay, just checking time-wise. Australian data, let's just quickly have a look at that. We do have labour market data that's out Thursday. That's expected to show another decent, healthy addition, actually. 25,000 jobs in April after the 53,000 added in March, with the unemployment and participation rates seen steady pretty much. And just a day ahead of this release, we also get actually Q1 wage price index data. That could be a key focus for the RBA, as Governor Lowe has emphasized the importance of basically the evolution of labor costs, I think he said, to justify the recent increase in the cash rate. Certainly then a big upside surprise in wage and labor data could continue to suggest a tight job market in Australia. Kind of bring back then, it would bring back sticky inflation concerns, and lead to quite a could be quite a tricky situation for the RBA. If you remember, of course, everyone presumed they were pausing, and obviously then they hiked. So money markets still give a pretty small chance, I think around 10-15% chance of another 25 basis point hike in June. So yeah, interesting pieces of data out of Australia, really the jobs and that wage data before that. As for the Aussie dollar, I did mention copper prices falling. Let's just quickly have a look at a copper chart. We don't go into it too much, but you can see it's just falling, losing support there late last week and through this black line, the 200-day moving average. Really interesting. On Thursday, you can see then, so a break of support, but now we are picking back up, and that's reflected definitely in the Aussie dollar. A couple of days lower, you can see, and then a push higher today. Sort of range bound, really, the Aussie dollar at the moment, stuck strong resistance at 68, so that's spot 0.68 you can see there. That tallies with the 100-day moving average at 67.88 as well, and then sort of lows around 66 levels. So tracking sideways. For us, the longer we track sideways, the bigger the breakout will be. That's sort of on a long-term basis, but you can see this tracking sideways here. We don't often do it. And then when we do, you kind of have decent sized moves. Let's just look. We've got some short-term fib levels in here, actually, of the October rally, and we're just bang on the halfway point of that, around 66.38 or so. So just above there, and sort of just above the 50-day moving average now at 66.80. Okay, I think we'll wrap it up there. Hopefully that's been useful to you guys. Lots of sort of data to look forward to this week, as opposed to central bank meetings. We're very data dependent, as I've said, as central bankers say. So certainly some of this data will affect the specific currencies going forward. Okay, do follow us, please, on social media if you like. And also we publish a daily report on the website that has sort of market thoughts, a look at the day ahead, and then also a chart of the day. Okay, we'll wrap it up as I say, but hopefully that's been of use, and we'll speak to you next time. Okay, take care.